The Philippine retirement landscape has been fundamentally reshaped in 2026 with the announcement of 7 transformative changes affecting both Social Security system and government service insurance system pensioners. These modifications represent the most comprehensive pension reform package in over a decade and will directly impact the lives of millions of senior citizens who depend on these monthly benefits for their survival and dignity. Every Filipino retiree needs to understand these changes immediately to protect their benefits and ensure they comply with new requirements that could otherwise result in suspended payments. The first groundbreaking change involves the implementation of mandatory digital registration for all pension beneficiaries across both systems. Starting in the first quarter of 2026, every SSS and GSIS pensioner must create an account on the respective mobile applications or web portals and complete a comprehensive digital profile. This profile includes personal information, contact details, bank account information for direct deposits, and designated beneficiaries in case of death. The digitalization push aims to modernize pension administration, reduce processing errors, and create more efficient communication channels between institutions and beneficiaries. For elderly pensioners who have never used smartphones or computers, this digital requirement presents enormous challenges. Many seniors in rural provinces lack internet access entirely, while others in urban areas may have phones but no knowledge of how to navigate apps or create online accounts. The institutions have promised assistance through branch offices and mobile service units that will travel to remote communities, but early implementation reveals significant gaps in support services. Children and grandchildren of pensioners are being enlisted to help elderly family members complete digital registration before deadlines that could result in benefit suspension. The second major transformation establishes a new tiered pension calculation system that differentiates benefits based on contribution history and retirement age. Under previous rules, pension amounts followed relatively straightforward formulas based on years of service and salary levels. The 2026 changes introduce additional factors, including the age at which members choose to retire and whether they continue working while receiving pensions. Early retirees who claim benefits at the minimum qualifying age will receive reduced monthly amounts compared to those who delay retirement beyond the standard age, creating incentives for extended workforce participation. This tiered approach reflects growing concerns about the financial sustainability of pension systems as Filipinos live longer and the ratio of active workers to retirees deteriorates. Encouraging later retirement helps balance system finances by reducing the number of years that individuals collect benefits while increasing their contribution periods. However, critics argue that manual laborers and those in physically demanding occupations cannot realistically work into their late 60s or 70s, making delayed retirement a privilege available mainly to office workers and professionals rather than a realistic option for all workers. The third significant change mandates quarterly life certification for all pensioners instead of the previous annual requirement. Every 3 months, beneficiaries must prove they are still alive through various verification methods, including biometric check-ins at designated facilities, video calls with verification officers, or in-person appearances at branch offices. This frequent certification aims to eliminate ghost pensioners and prevent families from continuing to collect benefits after a pensioner's death, a form of fraud that has cost the systems billions of pesos over the years. While the anti-fraud rationale is sound, the practical burden on elderly beneficiaries is substantial. Seniors with mobility limitations face particular hardship traveling to verification centers 4 times annually instead of once. Those living in remote barangays may need to journey for hours to reach the nearest certification facility. Bedridden or hospitalized pensioners require special accommodation through home visits by verification teams, but the availability of such services varies dramatically across regions. Some pensioners have already experienced temporary benefit suspensions because they missed certification deadlines due to illness or lack of transportation. The fourth transformation introduces automatic pension adjustments tied to the Consumer Price Index, replacing the previous system where increases required specific legislative action. Beginning in 2026, pensions will automatically increase annually based on inflation rates, ensuring that the purchasing power of benefits does not erode over time. This represents a major victory for pensioner advocacy groups who have long complained that benefits stagnate for years while prices continuously rise, forcing retirees into deeper poverty as their fixed incomes buy less and less. However, the automatic adjustment formula includes crucial limitations that could prevent increases even during inflationary periods. If SSS or GSIS investment returns fall below specified thresholds, or if the fund reserve ratios deteriorate beyond acceptable levels, the automatic increases can be suspended or reduced. This means pensioners cannot absolutely count on annual adjustments in years when the systems face financial stress. The formula also caps maximum annual increases at a certain percentage regardless of actual inflation, potentially allowing benefits to fall behind prices during periods of very high inflation. The fifth major change establishes strict new rules governing pension loans that allow retirees to borrow against their future benefits. Maximum loan amounts have been reduced significantly, and borrowers now face higher interest rates and shorter repayment periods. Most controversially, pensioners whose net monthly income after loan deductions would fall below a specified minimum threshold are now prohibited from borrowing additional amounts. These restrictions respond to situations where excessive borrowing left retirees with almost nothing to live on after loan repayments were automatically deducted from their pensions. The protective intent behind loan restrictions is clear, but the policy eliminates a financial lifeline that many families relied on for emergencies. When a grandchild needs urgent medical care or a home requires critical repairs, pension loans provided accessible credit for seniors who typically cannot borrow from commercial banks. The new restrictions push desperate families toward informal lenders charging usurious interest rates or force them to forego necessary expenses entirely. Finding the right balance between protecting vulnerable seniors from over-indebtedness and maintaining access to emergency credit remains contentious. The sixth transformation creates a unified beneficiary database that merges SSS and GSIS records for Filipinos who worked in both private and government sectors during their careers. Previously, these individuals maintained separate accounts in each system and often struggled to combine their service credits or maximize their total benefits. The new integrated system automatically recognizes all contributions regardless of sector and calculates combined benefits that properly credit entire working careers rather than treating private and public employment as completely separate. Implementation of this database integration requires massive data migration and reconciliation efforts. Millions of individual records must be matched, verified, and consolidated while ensuring no information is lost or corrupted. Early reports indicate significant technical challenges with the integration process, including duplicate records, missing employment histories, and discrepancies between SSS and GSIS data that must be manually investigated and resolved. Members attempting to access their unified records through the new digital portals have encountered errors and incomplete information, creating frustration and anxiety about whether their full contribution histories are being properly recognized. The seventh, and perhaps most consequential change, establishes new survivor benefit rules that substantially alter how widows, widowers, and dependent children receive support after a pensioner's death. The reforms expand eligibility for surviving spouses who remarry, allowing them to continue receiving reduced benefits in recognition that new marriages do not necessarily eliminate financial need, especially for elderly widows with limited earning capacity. Dependent children can now receive educational benefits through graduate school rather than just undergraduate level, helping families maintain educational investments even after losing a breadwinner. However, these expanded survivor benefits come with new means testing requirements that some surviving families will struggle to satisfy. Applicants must prove their total household income and assets fall below specified thresholds, requiring extensive documentation including tax returns, bank statements, property titles, and business records. For survivors working in the informal economy or engaged in seasonal agriculture, producing acceptable proof of income is extremely difficult. The verification process also invades privacy, as grieving families must disclose intimate financial details to claim benefits they previously received without such scrutiny. The combined impact of these 7 changes creates a fundamentally different pension landscape that requires all senior citizens to adapt quickly or risk losing benefits. The shift toward digital systems, more frequent verification, integrated databases, and complex new rules demands higher levels of engagement and capability from beneficiaries than the previous relatively passive system where pensioners simply received monthly deposits without much interaction with SSS or GSIS beyond initial retirement processing. Education and outreach efforts by both institutions have ramped up substantially to help pensioners understand and comply with new requirements. Nationwide information campaigns using television, radio, print media, and social platforms attempt to reach diverse audiences with varying levels of education and media access. Branch offices conduct daily orientation sessions for walk-in seniors seeking assistance. Partnerships with local government units, senior citizen organizations, and community groups extend the reach of education efforts into barangays and neighborhoods. Despite these communication initiatives, awareness remains dangerously low among certain vulnerable populations, including the very elderly, those with limited education, residents of geographically isolated areas, and seniors who are homebound due to disability or illness. These groups face the highest risk of missing critical deadlines or failing to complete mandatory requirements simply because they never received or understood the information. Targeted outreach specifically designed for hard-to-reach populations will determine whether the reforms achieve their objectives or inadvertently exclude the most vulnerable beneficiaries. The technology gap between generations poses particular implementation challenges. While younger seniors in their 60s who retired recently may have some familiarity with digital tools, pensioners in their 80s and 90s often have never used computers or smartphones. Expecting these very elderly individuals to suddenly navigate mobile apps, create online accounts, and complete digital certifications seems unrealistic without substantial hands-on assistance. Family members play crucial roles helping elderly relatives, but not all seniors have nearby children or grandchildren available to provide such support. Regional disparities in administrative capacity mean these reforms roll out very unevenly across the archipelago. Metro Manila and major cities have abundant branch offices, reliable internet infrastructure, and numerous staff trained on new systems. Provincial capitals and larger municipalities have moderate capacity with some delays and service gaps. Small rural municipalities and remote barangays struggle severely with limited facilities, poor connectivity, and officials who may themselves be confused about proper procedures. This geographic inequality in implementation creates situations where pensioner experiences differ dramatically based simply on where they happen to live. The fiscal motivations underlying these reforms reflect genuine concerns about long-term pension system sustainability as the Philippine population ages. The ratio of active workers contributing to each retiree receiving benefits has been steadily declining and will continue deteriorating for decades. Without reforms to control costs and enhance revenues, actuarial projections show SSS and GSIS reserves eventually depleting, leaving systems unable to meet obligations to future retirees. The 2026 changes represent attempts to forestall such catastrophic scenarios through incremental adjustments rather than waiting for crises that would necessitate more drastic measures. However, pensioner advocates argue that sustainability concerns should not be addressed primarily by reducing benefits or creating barriers for vulnerable elderly citizens to access support they earned through decades of contributions. They advocate instead for reforms that enhance system revenues through higher contribution rates on active workers, better investment returns on accumulated reserves, improved collection of delinquent contributions from employers, and possibly even general revenue subsidies from government budgets. Placing the adjustment burden mainly on current retirees rather than spreading it across all stakeholders raises fundamental fairness questions. The political economy surrounding these reforms involves complex dynamics among pensioner interest groups, labor unions, business lobbies, and fiscal conservatives within government. Each stakeholder group has different priorities and different preferred solutions to sustainability challenges. Pensioners naturally want maximum benefits with minimal restrictions or requirements. Active workers resist higher contribution rates that reduce take-home pay. Employers oppose measures that increase their labor costs. Fiscal hawks demand cuts to pension expenditures to reduce budget pressures. Navigating these competing interests to achieve politically viable reforms that also address genuine sustainability concerns requires difficult compromises. International experiences provide both warnings and potential models for pension reform in the Philippines. Countries throughout Latin America, Europe, and Asia have grappled with similar demographic and fiscal pressures on retirement systems. Some have shifted toward individual retirement accounts and reduced reliance on pay-as-you-go public pensions. Others have maintained public systems but raised retirement ages, increased contribution rates, and adjusted benefit formulas. Still others have created multi-pillar systems, combining public, occupational, and private elements. The Philippine reforms reflect relatively modest parametric adjustments rather than fundamental structural transformation. The implementation timeline for these 7 changes has been compressed into a remarkably short period, creating stress for both administrators and beneficiaries. Ideally, major reforms would phase in gradually over several years, allowing systems to be tested and adjusted based on early experiences before full implementation. The rushed timeline appears driven partly by political considerations and partly by urgency given deteriorating system finances. However, hasty implementation increases the risk of technical failures, administrative bottlenecks, and unintended consequences that harm vulnerable beneficiaries. Monitoring and evaluation mechanisms must track how these reforms actually affect pensioners and whether promised support services for compliance materialize effectively. Early warning systems should identify beneficiaries at risk of suspension due to noncompliance so that targeted assistance can prevent unintended exclusion. grievance and appeals processes need adequate resources to handle the inevitable surge in complaints and disputes during this transition period. Transparency about implementation challenges and willingness to make mid-course corrections will determine whether reforms succeed or create chaos. The 7 major changes announced for 2026 represent a watershed moment in Philippine pension policy that will shape retirement security for current and future generations. For the millions of senior citizens directly affected, these reforms demand immediate attention and action to ensure continued access to the benefits they depend on for survival. Understanding the specific requirements, meeting all deadlines, seeking assistance when needed, and staying informed about ongoing developments are essential strategies for navigating this transformed pension landscape successfully.